Mehta. I am a director on the Association of National Exchanges Members of India. This is the largest representative body of brokers. And I'm sure that all of you who are listening or tuned in today's program are either a broker or they are dealing in the capital markets through a broker friend of ours. Today, I am also a stockbroker. I'm a member of Bombay Stock Exchange and National Stock Exchange. My company name is MEFCOM Capital Markets Limited. I am the head of the company. My name is Vijay Mehta. Today is a very auspicious day because yesterday only we touched a lifetime high in the stock markets. Somebody might come back and ask that when equity is giving a return like this, then what kind of financial planning do we need? I think in today's context, financial planning has become most important way of now managing your finances. Financial planning has always been a very, very important method to manage your money because at different stages of life, you need money for different purposes, like getting married, for your higher education, for buying a house, for buying a car, for your retirement, for buying another office, and so on and so forth. Even now, when the equity markets are at all-time high, I think you need to plan your money very well so that you are able to save enough for your future needs. It has almost become like an art. And the artists today who are with us are probably the best in India for this kind of advice. We have very accomplished panel who are going to tell you about the financial planning. We have representatives from HDFC Securities Limited. We have the general manager of Bombay Stock Exchange, which is the largest exchange in the world, and Mr. Anjaney Gautam, who is from JM Financial. All these names are very well known to you. I would like to, we have designed the structuring of this program in a manner that you are able to get the full benefit from each of the panelists. We will first have from HDFC Securities, then from Bombay Stock Exchange, and then from JM Financial. And I, as a moderator to the program, I will introduce every speaker of mine before they start speaking. So I have the great pleasure of introducing you to Madam Sapna Punjabi. She is the Regional Investment Advisor of HDFC Securities Limited. Sapna is a certified financial planner with a career spanning over 17 years. She has a sound knowledge of financial markets and has been advising clients on a wide array of financial products across equity, debt, and alternate asset classes. She has also worked extensively in the domain of goal-based financial planning, retirement planning, and portfolio management. I would now request Madam Sapna to please start addressing the audience and make her presentation. Thank you.
Thank you, Mr. Mehta. Good evening to everyone. On behalf of HSL Investment Advisors, it is indeed a pleasure to be here today among this distinguished audience. So 2020 has been a very unusual and challenging year for most of us. And from the stock market perspective, of course, we've seen the market, show wild bouts of volatility right from March onwards when the pandemic was announced. And of course, we have seen an equally sharp recovery to all-time highs. But in the midst of all this, all our investors, several of them have been completely confused. And many of them also feel that they have totally missed the rally. So what financial planning does actually is help investors to actually overcome the behavioral biases, and it kind of cuts out the noise and provides a customized financial solution by which an investor can achieve their individual aspirations as well as achieve their financial goals. So, what I will be covering today is a brief overview of the financial planning process, as well as certain concepts that are connected to it. And without much ado, let's get to that. So, I hope my screen is visible. So, of course, all of us would hope that life is a smooth journey and we don't face any obstacles and hurdles. But unfortunately, that is not the case. And there are times when we have to face rough weather, we have to face all the ups and downs of life. And it is important that in these circumstances, we have a financial portfolio that is strong enough or that is stable enough to see us through these difficult periods. So, if you actually get down to the basics, we all have a regular income and we also have regular expenses, and the net of these is our savings. Now, if we let these savings just remain the way they are likely to depreciate over a period of time. However, if we channelize these savings into investments, these investments can actually appreciate over a period of time, and by this, we can actually achieve all our goals. So why should I invest? Of course, like it was covered, that mainly to achieve our goals, which could be buying a house, buying a car. Children's education is a very important goal that most families have. And also, most importantly, we need to plan for retirement in advance. So, fulfilling goals is one of the main purposes as to why we need to invest. Apart from that, we have seen in India that inflation is generally on the higher side. In the past, we've also seen inflation in double digits. And it is important that our investments are able to beat inflation and give us real returns. The government in India does give us certain provisions by which we can actually invest in those and reduce our tax liability. And thus, we are also able to have more cash in hand to fulfill our ambitions or our aspirations. So, reducing tax liability is an important consideration when we make our investments. And over and above our goals, if we are able to actually create passive sources of income, and also we are also able to do wealth generation in the future, that is an important goal of investment as well. Now, when we actually define our goals, it is important that we define our goals in terms of SMART goals. Very often we have vague goals. For instance, I may say I want to buy a car in the future, probably somewhere 2, 3 years down the line. So it is important that we actually articulate our goals very clearly. We specify the time period as well as the cost associated with each of these goals. So the same car goal can be put across as I am looking to buy a car 2 years down the line, and the approximate cost of this car is approximately 10 lakhs. So by articulating our goals in this way, we can actually create an investment strategy that is clearly directed towards achieving each of our goals. Now, before I get down to the actual financial planning process, it is important to understand the power of compounding. So, assume if I can show this with an illustration of a children's education goal. If I have a child and say 10 years down the line, I have to plan for the graduation of that child, and I approximate the cost of this goal to be 10 lakhs, I would have to first understand what is the future value of this goal. So we have seen the trends in education to be at approximately 10% inflation, though the regular inflation is around 6%. But if we look at education and the cost of education over the years, we have seen that education inflation is actually around 10%. So actually, after 10 years, the cost of this goal can shoot up to as much as 26 lakhs. And hence, I need to plan for this well in advance. If I start planning for this goal today and assume a return of around 12% on my investments, I need to make an investment of around 11,000 rupees every month to accumulate this amount of 26 lakhs. However, if I postpone this goal, or if I postpone the investments to this goal by 5 years, you can see that the amount mushrooms or balloons to at least 32,000 per month. The point I'm trying to make is that it is important to start today. And most of us tend to procrastinate, tend to postpone our investment strategies, or simply feel that we do not have enough to start investing today. However, as I said, rather than time our investments, it is actually important to start the investment process. And this will lead us onto a path by which we can easily achieve our goals. Taking another illustration, if I need to accumulate a corpus of say around 1 crore for my retirement, and I'm expecting a return of around 12% from my investments, I would need to save 1,24,000 if I have just 5 years to save this goal. However, as my investment horizon increases, you can see that my investment amount reduces dramatically. So much so that if I start planning for this 30 years in advance, I need as small an amount as 3,250 to actually accumulate a corpus of 1 crore. So what is financial planning? Financial planning is the process of meeting one's life goals through the proper management of your finances. What are the different aspects of this? It is a very holistic process. We are not looking at just individual products. We are looking at the entire family's needs. And we are also looking beyond the investment process and the actual investments to other aspects of our financial strategy as well. Apart from that, of course, it helps us to clearly articulate and define our goals. It also helps us to prioritize them. So while a family may have several goals, once you prioritize these goals and decide what's most important, you start channelizing your investments towards these goals. And in future, as the surplus increases, as your income increases, you can also start allocating funds and your savings towards the other goals as well. It helps us to protect the family against the unknown. This is something that I will cover a little more in detail. It ensures liquidity. Now, liquidity is a very important aspect. Many a times we have seen that our investments are locked into long-term products, and it is not easy to liquidate these when we actually need the finances to achieve our goals. So through the process of financial planning, we make sure that there is adequate liquidity in the portfolio. And when the milestones are nearing, we can actually use these funds to fulfill our goals. Finally, of course, once we have taken care of our goals, as I mentioned, we are also able to channelize our surplus funds towards wealth creation. And this corpus can be used for various purposes. It can be used for some people to set up their own, startups or their entrepreneurial ventures. It could be to, probably do some philanthropy, to even travel, or if nothing else, we also can pass it on to our heirs. So this is the financial planning pyramid. Of course, each of these aspects is equally important, but for simplicity's sake, we need to start with the most important ones, and that is towards creating contingency and creating a protection plan for the family. So contingency fund is nothing but a corpus that we set aside to meet any kind of emergency situations. Normally, it is around 3 to 6 months of our expenses. And this is set aside in instruments which are easily liquid. So it could be FDs, something like a sweep in FD, or it could also be liquid funds which are easily accessible. And this is used to meet emergency situations. We all know that even during the pandemic, there could be situations where we are going through medical emergencies. Some families have also experienced, job loss, and people have also had to face pay cuts. So it is during these difficult times that the contingency fund can help us to tide over the situation. The next part, of course, is risk protection. So risk protection is nothing but taking adequate insurance to meet any unforeseen or unknown events. Now, as far as the financial planning is concerned, the two main risk protection goals are ensuring that the individual has adequate life insurance, as well as the entire family is adequately covered in terms of medical insurance. So, life insurance is a very, very important aspect of financial planning. So, it can be very traumatic for a family to lose a loved one. And in addition to that, if the family is not adequately taken care of in terms of their financial needs, this could lead to a lot of hardship for those family members. Hence, it is very, very important that even before we make any investment strategy, we ensure that the individual has adequate life insurance. We do a need-based calculation, but if you go by thumb rules, a person should have at least 10 to 15 times of their annual salary as life cover. There are different kinds of plans. You could take ULIPs, there are child plans, of course, traditional plans. But the best way to take a large life cover is to go in for a term policy by which we can get a large life cover at a relatively lower insurance premium. So, talking about health insurance, again, we have seen that in the pandemic, there have been a lot of people who have been medically impacted. And in such cases, if you aren't covered by a good medical policy, what will inevitably happen is that you are likely to dip into your savings, and this will jeopardize the achievement of your other goals. So typically, we suggest that every person in the family, including children, as well as the senior citizens, have a medical cover of approximately 5 lakhs. You can also couple this with a top-up cover, which comes at a more reasonable premium, and hence you can enhance the overall life medical cover to approximately 15 to 20 lakhs. Apart from medical insurance, there are other insurance policies as well, such as critical cover and a personal accident cover, which is advised so that you are adequately protected. Moving on to the actual investment planning now. Before we actually go into that, it is important to have a good understanding of what are the asset classes that are available to us. So typically, we see these are the asset classes available. Debt is characterized by kind of a capital protection and also a regular return over a period of time. Now, this because we are getting a regular return as well as ensuring capital protection, the returns are normally low. We have seen there are, of course, several instruments in debt. Typically, we have invested in FDs, we have bonds, debt mutual funds, and even the contributions that we make towards employee provident fund and public provident fund come under the debt category. So what we need to ensure, of course, since the returns from debt are generally lower than other asset classes, we need to ensure that we have a portfolio that is adequately diversified, and hence we need to incorporate other asset classes as well. So if we are looking for slightly higher returns, equity is an important asset class to have in the overall portfolio. And when we say equity, it is nothing but investments into stocks. And this can be done either through direct investments into stocks, or it could be done via the route of mutual funds or other structures such as portfolio management services. The third asset class is real estate. Now, in India, we have seen that real estate is a popular asset class, and we have seen very good returns over the long term, which is over the last 10 to 15 years, and even beyond that. But the point here is that real estate is an asset class wherein a lot of liquidity gets locked in. So we must make sure that there is adequate liquidity in the portfolio before we actually invest into real estate. It's important to have your primary house, but when we are talking of a secondary property, then we must first make sure that we are planning for our other goals before we start investing into real estate. And real estate in the long run, probably during the retirement phase, can prove to be a very good investment because it can provide us with passive sources of income. Moving on to gold, again, this is a favorite asset class that Indians like to invest in, and we have seen very good returns also coming from this asset class. And typically, we advise our clients to have at least 5% of the overall portfolio invested into gold. This is a good hedge against inflation. And earlier we had not many avenues to invest in gold, and people used to buy physical gold as well as invest in jewelry. But now it has become extremely easy to invest in gold through the financial route as well. And we have gold ETFs and the sovereign gold bond fund, which is provided by the government. These are very easy avenues for investment in gold, where the transaction costs are low and the liquidity is also very high. So apart from these, we have the last asset class, which is alternates. Here again, this is for a certain niche set of clients, because the investment amount here is 1 crore and above. And those clients who have actually, created enough surpluses or enough assets to cover their core goals, and they have surplus beyond that, can also invest into alternate asset classes, which could be in the fund of which could be in the form of uh, angel funding. It could be private equity and funding for startups. So this is just a brief comparison of the returns that we have got from different asset classes over the last 15 years. And I would like to actually focus on the last two, which is the bank deposits and Sensex or equity returns. So what we have seen is that while bank deposits have given us returns of around 7.6% or over 7%, if you actually factor in inflation, which has been around 6% approximately, you can see that the returns from bank deposits have been just around 2% or less. Whereas if you compare it to returns from equity, we can see that even after factoring inflation, we have healthy returns or real returns of around 7%. The point I'm trying to make here is that it is important that when we are creating our portfolios, to have a portfolio which is well diversified, which will not only have allocation to debt, but also allocation to equity, so that we are able to beat inflation over the long term and generate good real returns in our portfolio. So when we actually are doing our asset allocation, it is a common question for our investors to ask, how much of debt do I need to have and how much of equity in my portfolio? So this is determined by a few factors. Chief among these is, of course, our risk profile. And based on this risk profile, we are able to judge whether an individual is conservative, moderate, or aggressive. Now, a conservative investor is someone who's typically very uncomfortable with volatility and would prefer to have safe instruments and regular returns. So there we have a higher allocation to debt and a lower allocation to equity. A moderate investor can have a kind of a 50-50% kind of an allocation, whereas an aggressive investor is someone who is more comfortable taking risk in their portfolio. They understand the volatility of equity markets, and hence we are able to give them a higher allocation to equity in their portfolio. In fact, when we do give a higher allocation to equity, nowadays it has also become kind of important to be understand the importance of international investments and take a small exposure to international equity as well. And this is only when you understand the pros and cons of it. So depending on the risk profile of the investor as well as the horizon to our goals. So not only do we consider the risk profile, we also consider the horizon to our goals. That is important, because if we have a lot of near-term goals, we must have adequate investments in debt to ensure that we are able to safely meet these goals. So as I said, depending on the risk profile and the investment horizon to our goals, we decide what is the overall asset allocation to be in our portfolios, and hence choose our products accordingly. So when we are doing our investment planning, simultaneously, we must take care to see that we have also done our tax planning in the right way. The government, as I mentioned, provides us with a lot of provisions by which we can take advantage or take benefit of these provisions and reduce our overall tax liability. Typically, among these is Section 80C, where we can invest up to 1.5 lakhs every year in different instruments such as ELSS funds of mutual funds. It could be also in long-term deposits, which is 5 years. Our contributions towards PPF and EPF are considered under 80C, and even the life insurance premium that we pay can be deducted from this particular ATC deduction. Uh, Apart from that, the health insurance premium that we pay, this is covered under Section 80D. And over and above our ATC, we also have 50,000 separate allocation towards NPS. So those who wish to invest in NPS can avail of this benefit also. So here is an illustration showing you that a person who is drawing an annual salary of around 10 lakhs and is availing of all the benefits that are provided by the government. If you do avail of all these benefits, your actual tax liability can be nil. However, this year, when the budget was announced by the finance minister, a second option was also announced by which those individuals who are not taking benefit of these provision can actually have lower tax slabs, and hence an individual can decide whether they would like to follow the old regime or the new regime. And for this, we must actually, calculate on paper which is beneficial to us, or we can even consult a tax advisor and see which regime, the old regime or the new regime, which is beneficial to us. Coming to retirement planning, now this is an extremely important part of the financial planning. We have seen that insurance helps us to cover the risk of dying too early. But over a period of time, what we are seeing that the life expectancy in our country has been going up. And 30 years back, the life expectancy was approximately 60 years. But today, if we see, the life expectancy in India is 70 years. So hence, we have to make sure that the corpus that we are creating for retirement also covers the risk of living too long. And as I mentioned earlier, it is always important to start early. You can see that if we start with a small amount of 5,000 rupees and we have 30 years to go for our retirement, we can easily collect a corpus of over 1 crore. However, if we postpone this planning for retirement and we start planning for retirement only at the age of 50, we can see that the corpus accumulated would be far smaller. So the strategy for retirement planning is very different as compared to the initial years when a person is working. That part is known as the accumulation phase. So we have a regular income at this point of time, and our surplus is used to achieve all our milestones and all our family goals. However, when it comes to retirement planning, the income actually stops now, and the corpus that we have collected by this point of time must be very wisely distributed across different asset classes to ensure that we have a regular income that helps us to meet our standard of living, a standard of living that we were used to even before retirement. And at the same time, it must also generate real returns which are able to beat inflation. Else, what would happen is over a period of time, we will start dipping into our retirement corpus, and our retirement corpus will deplete very rapidly. Coming to estate planning, finally. So this is a very, very important responsibility for all of us. We must make sure that all the assets that we have built up have nominations in place. And apart from that, we must write down a will. This may or may not be registered, but it is important to put down all our assets to avoid any kind of litigation in the future. And in case of complex family structures and special situations, for instance, we may have a special child in the family, or we may have a very large, business families and large holdings. In such cases, it is better to have a trust as the preferred structure for succession planning. So just a quick recap of the overall financial planning process. As I mentioned, it is first important to articulate clearly and to define your goals. We also estimate the future value of these goals by factoring inflation, which is very, very important. We then get an understanding of what the current situation of the investor is or the individual is by assessing or analyzing all the existing investments and also reviewing the portfolio. And we see where the gaps are there, and the future strategy is planned accordingly to ensure that these gaps are fulfilled and there is adequately adequate liquidity created to ensure that we meet all the important goals of the family. From time to time, it is very important to review and monitor the investments. There could be changes in the family situation. There could be changes in goals. So hence, we would also need to modify the plan accordingly from time to time. Finally, just a quick brief about our company. Of course, we are a SEBI regulated and SEBI registered investment advisor. We have a pan-India presence. We are part of the larger HDFC group, and we provide end-to-end advisory solutions, not only in terms of financial planning, but also in portfolio reviews, retirement planning, as well as portfolio management. We have a very diverse product platform, and for ease of transactions, the entire product basket is now available on the digital platform as well. With that, I would like to conclude my presentation, and I would invite the next speaker to take over from here. Thank you.
Thank you very much, Sapna. We really appreciate. I am sure that those who have heard you, especially in the salary group, they have been largely benefited with your presentation. And I have now the pleasure to invite our second speaker, Mr. Purushottam Saraf. Mr. Saraf is the general manager at the Bombay Stock Exchange, and he works as the head of products in the stock exchange, which is today, as you all know, BSE is Asia's first stock exchange, and today ranked first in the world in terms of number of stocks listed. Mr. Purushottam is working with them for the last about, I would say about from 1997. He is working with BSE, and for the last 22 years, he is looking after BSE's products. He's a director on the board of Calcutta Stock Exchange also, and a subcommittee member of CII Eastern Region on Economic Affairs and Finance. He was in jury panel to select winner of IIM Calcutta HULT team. Mr. Purushottam holds a Bachelor of Engineering in Electrical Engineering from Delhi College of Engineering in New Delhi. He passed out in 1989 and did his postgraduate diploma in business management from IISWBM Calcutta in 1993. He is a INSM approved CPE trainer for currency derivatives and equity derivatives, and teaches finance, stock market, primary markets, etc. I would now request Mr. Purushottam Saraf to please start with his presentation. Thank you so much.
Thank you, Vijayji. I think Sapna Madam has covered a lot of things. And how much time do really I have?
Well, please go ahead. We would love to listen to you. How much time, whatever time you would like to take within the ambit of our program timings.
Okay, thank you. So I'd like to, Sapna has covered already that stock market has given higher return than FD, gold, real estate. We have seen those numbers. So we are very clear that stock market is a better platform, is a platform where you can make, you can get a higher returns. But in India, what is happening? In India, what actually is happening, that is very different. We have a regulator, SEBI, and in last 25 years, they have done a lot of investor education program. They have started with the concept of KRA, KYC, SMS, monthly updation of your ledger, daily updation of your. So a lot of thing has been done for protection of investor interest in last 25 years. And our market, which was earlier around 400, 500 crore rupees, now is more than 10 lakh, 20 lakh average traded volume daily. We started only from an equity class. Now we have all the asset classes available, like equity derivative, currency derivatives, commodities, interest rate. So all the products which are worldwide available are available to Indian investors also. But what really has happened, that we majority of Indian investors think investing as an extension of gambling. and have no distinction between investing and gambling. These people think stock market exists only to get rich quick scheme. That is the reason we value land, gold, FD ahead of stocks, because it takes less skill to buy a piece of land or make a FD than to buy a stock. As a consequence, traditional mindset of percentage of Indians who think wealth can be made by investing in stock market through research remains very poor. Some words like corporate profit, free cash flow, dividend, growth rates, these numbers, these terms for them is manipulated and meaningless. The idea of being provided with ready-made buying tip is always preferred to the process of undertaking serious research. Nobody wants to take a pain. Everybody is looking for a word tip. मुझे एक कोई tip दे दीजिए. And tip you spelled it backwards, it is pit. So tips take you to the pit. गड्ढे में लेके जाती है बस. Tips हमेशा आपको गड्ढे में लेके जाएगी. Gains from stock market are non-linear. They are not going to pay your regular bills, but it comes in bunches. So an investor who is going to consider buying stock in a company, he should feel that I am becoming a part owner in this business. In short run, there can be rise and fall, but if the company does well over a period of time, reward and ownership both through dividend and capital appreciation will come to the investor. Another advantage of equity investing is the ease of exit. You can exit anytime. Electronic mode is there, and we work on T2 basis, which is the fastest, best mechanism. So I'll continue. So investor who identifies one big investment idea every 12 months make more money than an investor who finds every 12 hours a new stock. Every 12 hours we try to find a new stock and then we try to take position in that. Short-term traders engage in trading because they get hooked to charm of making big money. And we have seen that 99% of the traders don't make money. This hobby slowly becomes habit and then becomes an addiction. And there they have to, for every habit and hobby, we have to pay, whether it is golf, smoking, drinking, whatever it is. So trading becomes some sort of a habit for them and hobby for them, and then they start paying. So we want to change the mindset. We have a lot of products available. You have to choose the correct product for you. There are various products available. There are certain products where value appreciation will happen over a longer period of time. And there are certain tools, certain products which are going to hedge your risk. What we investors are doing in India generally, again, get rich quick scheme tells me to go for a option buying or option selling, where we know either we'll make it 99% or we'll lose it. Lag gaya to chakka, nahi to out. So with this concept, if you are trading, honestly, this market is not going to grow. This market is not going to grow. We have seen already number of investors, according to SEBI report, which came in 2018, has shown that number of investors are not increasing, except for this COVID period, if we remove. Otherwise, the number of investors has not really increased. Even the market size has increased substantially, but participation has not increased. I don't know. Even SEBI has done a wonderful job in terms of protection and making things, everything online, like availability of their toll-free number, scores, all complaint resolution within 15 days. So they've done everything possible for investor protection. But I don't know, where somewhere we are not able to give a correct product to the investor. People are not able to identify what product is suitable for me. So this is very important. So we should be investing, we should be looking for a stock which moves 10 times over a period of time. We should not look for something which will give a 10% return in 2 days, 3 days. But most of the time we look for these kind of stocks, and we end up most of the time losing money. Even if I make some money in some stock, I'll sell that stock. जिस स्टॉक में मैं जीतता हूं, कुछ अच्छे पैसे बनते हैं, अच्छे ट्रैक पे जाता हूं, I make it as a depreciating asset. मैं उसको बेच देता हूं, और जो खराब स्टॉक होता है मैं उसके साथ में कंटिन्यू करता हूं. एंड जो अच्छा एसेट लॉन्ग टर्म में मेरे लिए एक बहुत बड़ा एसेट बन सकता था, मैं उसको सेल करके एक डेप्रिसिएटिंग एसेट खरीद लेता हूं, एक टीवी खरीद लेता हूं, एक मोबाइल खरीद लेता हूं. So what we are doing means correctly, we don't have a time period horizon. We don't understand what product is required to meet my financial goal, which is 25 years ago or 10 years ahead. So people has to correctly identify the product which is good for me. So process of getting rich for a big everlasting smile entails sacrificing a lot of small happy moments. You have to sacrifice a lot. You have to do many sacrifices if you want to have goal, which Seema was talking about, Miss Punjabi was talking about, that these kind of wealth you can create, and if you have those goals. So we'll always have a fight with we'll always have a fight that will always look for short-term and long-term goals. So it is very important that what we are buying, it is not a short-term thing. Stock market is a value-driven market, and it gives you return over a longer period of time. And you have to do research. You don't have to waste your time in tips, waiting for tips. You have to identify. There are plenty of information available, lot of information free of cost available, courtesy Google and Geo. So you can search any company and do any kind of investment. I've met lot of people who said, sir, 25 साल पहले कंपनी का फला फला 10 शेयर मिला था, बच्चे की शादी हो गई, पढ़ाई हो गई, एक बड़ा पोर्टफोलियो बना लिया. तो हमको एक अच्छा गोल, अच्छा प्रोडक्ट लेना पड़ेगा, लॉन्ग टर्म का कमिटमेंट रखना पड़ेगा, तब जाके हमारा फाइनेंशियल प्लानिंग कंप्लीट होगी, और हमको उसमें समय देना पड़ेगा. I think with this I would like to close, and I would like to give time to Anjane. Thank you, Vijay ji, for giving this opportunity.
Thank you, Purushottam ji. Thank you very much. In fact, I can say that this is advice coming from a very mature person in the markets, and those who somehow did not pay full attention to his speech, I would like to highlight a few points which he has given as a strong piece of advice to everyone, all the listeners. He has said that it is a myth that investing is gambling. It is not. It is also a myth that stock markets are a door to becoming rich quick. They are not. Actually, if you are coming to the stock market and you are going to invest, equity is a good option. He has devoted most of his time in identifying equity as a good asset class, because the details of different financial planning is being presented earlier by Madam Sapna, and now by our next speaker. The number of investors in India is low as compared to other developed countries. And unless we really understand and do research in the markets, we will not be able to increase our numbers, because those who are only depending on a tip to make quick money are actually not able to do so. And then they get disappointed and they leave the markets. So he has advised that he has used a very good simile that the tip is actually a pit. I mean, like if you reverse the alphabets, and one should always invest by doing research into the product and not on the basis of hearsay. then one should also look for a long-term investment. Shifting your portfolio every now and then does not bring you the kind of returns as a long-term investing can do. I still remember that 10,000 rupees invested in Infosys in the year 1977 or so is today somewhere, I don't know, I mean, like it is running into tens of crores. So there are a lot of scripts which are being in the market. I can quote about 10 of them instantly, though I am not doing it, which has given your lifetime planning if you have stuck to the investment. According to Mr. Saraf, 99% of traders who do it daily and shift their portfolio don't really earn good money as compared to a long-term investor who makes investment on the basis of the doing a research. So we are now coming to our next very outstanding speaker, Mr. Anjane Gautam. He is the Associate Director of JM Financial Services Limited, which is again uh, one of the best companies in India to work for in the field of financial services. He has an experience of more than 18 years in the field of investment, product management, digital platforms, and advisory. And before working as Associate Director in JM Financial, he was working with another leading company, Bajaj Capital. At JM Financial, he is managing the sales strategy, product and technology initiatives, design and started arguably India's first financial planning service. Well, Mr. Gautam designed and started India's first financial planning service for masses with Bajaj Capital in 2003-4 under the brand 360-degree financial planning, with extensive learnings from doing financial planning for retail at high net worth investors for almost 4 years. Added technology know-how to improve the service delivery of financial planning practice. By education, Mr. Gautam is an MBA Finance from Aligarh Muslim University with a Bachelor of Commerce degree. I would request Mr. Gautam to please start with his presentation. Thank you.
Thank you, Mr. Mehta. Thanks a lot for your kind words and introduction. It's really a pleasure being here among all of us, all the audience, all the reputed dignitaries on the discussion today. And I'm sure there are many people who are more knowledgeable than many others. But whatever contribution we can make to the discussion, that's our effort. Thank you for introducing my organization, JM Financial Services Limited. I'm really proud to be associated with this organization, which is almost 40 plus years in the financial services domain, and it covers almost every product which is there in the financial services. And I represent one segment of the organization which deals with the partners, or as we call them as independent financial distributors. So all our distributors are very happy with us, reason being because we are not a single product distributor. We are a multi-product platform which provide all kind of services, all kind of products which are available in the markets to all their customers. So it's a geographic reach of across India and across multiple products that has given us learnings on various aspects. But of course, as you mentioned about my previous experience, so financial planning is something which is core at the heart. And we would love to get down to business with any of a client, interacting with them and going down to each and every aspects of financial planning. So before taking any further time, let me just add to the discussion. So Sapna has very beautifully presented the concept of financial planning, and she gave very in-depth understanding of the concept and the exercise that we do while doing financial planning. Mr. Purushottam gave insight into what are the products that can be used for financial planning and investment otherwise. What I'm going to bring in is a practical implementable ideas for whether you call it investors or the participants who are themselves practitioners on the investment advisory or investment services side of it. So I'll keep it very short, very limited, 3 broad ideas, and I'll leave you in the end with a small exercise, which I'm sure should be thought-provoking for some to start with. So like we say, financial planning or investments, it starts with a no. Most of the investors generally say, I don't need it. There can be many reasons, even Sapna touched upon it. Maybe you don't have money, or you are professional enough, or you have enough knowledge. So generally the advice or the structure of financial planning starts with no, it is not for me. So this is where we always come in and say that here we need to correct something about ourselves, our life, our financial life. So like this is one quote which I'm sure you're able to see on the screen. Give me 6 hours to chop down a tree and I'll spend first 4 hours sharpening the axe. Financial planning is something like that only, because you are ultimately living, learning, earning for your family, not only to meet the next month or current month expense. You are actually earning and saving so that you can meet their expenses in future and plan for something which is for yourself, that is post-retirement. Because that is one time, at least in India, so to say, we don't have enough provided or central or government provided support where one can meet all expenses or medical requirements post-retirement. And we are no more living in the joint family system where some kind of support can come in for everybody. So you are actually spending these 4 hours or initial 5, 7, 10 years for your future savings, which are going to make your life or your loved one's life comfortable. So financial planning is something which is start with slow approach, but gradually it builds over it and it gives you benefit in real long term, which is where Mr. Purushottam also mentioned something about investing for longer period. So just to give you a discussion outline where I'm going to touch upon. One, financial planning and behavior. Very brief, how the whole exercise or whole interaction of financial planning starts. I'll just briefly touch upon that. Ms. Swapna mentioned about goal-based planning she has been practicing. So there are two approaches to financial planning, goal-based and cash flow-based. So I'll touch upon both the things and present both the things to you in a very simple and precise form so that you can take your own practical decision on it. Insurance is one thing which is at times either pushed or it is at times not rightly introduced or understood. But it is at the core of financial planning and core of the requirement for anybody's individual personal financial life. So understanding insurance in the right way and how you can optimize the requirement or optimize the understanding of insurance is something which I'll touch upon in a brief discussion today. And investment portfolios, asset allocation, how to construct a portfolio. These are discussions which everybody understands, or rather you would find many notes on it. I'll just touch upon before starting, a step before you start constructing your investment portfolio. So these are few different thoughts which I thought will be helpful for all of you and all the audience if I can contribute to your understanding on that. And in the end, of course, a small exercise on retirement planning, which I'll leave with so that all of you can do your exercise and look into it. So moving to straight part, financial planning and behavior management. Believe you me, whenever we interacted with any client, first instance view was, why should I give you my information? It is core to my financial life or my personal life. Why should I give you details like how much do I earn or how much do I spend and what are my future goals, etc. So this can come in only if the person who is investing or who is your customer trusts you. So the first part or first stepping stone for financial planning is trust. And to build trust, there are many things which we need to do. And one of the things is transparency that we need to bring in. The communication is one part which has to be regular, unbiased. And that is where the trust gets built. So when I'm saying all the other points which are coming below trust here in the discussion are somewhere or other to build trust of the client. So the confidentiality, information, personal or privacy, these are all things which client comes up with. And without that, you cannot complete a financial planning exercise. So the communication is the second part which comes in very, very important. And information, whether you are sharing very limited information or you are sharing the relevant information. That is very important in case of a financial planning discussion. And last but not the least, a financial planner or an advisor should have the courage to say no. The biggest mistakes in investment do not happen because you buy the wrong product. Biggest mistakes happen because sometimes, or rather majority of the times, we take the wrong decision of entry or exit. I'm not talking about the timing of the market. I'm not talking about the product, but it is about how and what product you're offering, you're opting for, and what time you're buying it, etc. And rather, in the biggest of the cases, what time you're exiting it. So the advisor or the distributor should have the courage to say no to the sudden outburst, behavioral outburst of the client. So I'm sure you must have read many of the reports that markets have given returns, but investors have not made returns. And the biggest hurdle for this thing is nothing else but the behavior. So building trust is the most important part. Rest all things which are there on the slide are just the support. Trust is the biggest thing that we need to build while interacting with the client. And as a practitioner, we have seen that no financial planning meeting gets concluded in one meeting. It runs over 3, 4, 5 different meetings. And in fact, in the first meeting, we have never seen any client getting convinced with everything. Even if a client is getting convinced, probably he's either too smart or he's completely naive, because we need to understand everything and have to go about it. And in the first interaction, we should never discuss about product, not even in the second, maybe in the later ones. So the first part is trust, interaction, build over it, discover the client's requirement, build a plan, and then implement it. So trust is one part, which is where the most important thing. This is the same guidance even to the investors. When you choose a financial planner, look for the trust factor and then move forward on that part. Coming to the next part, which is how do we look at goals? Goal planning or goal-based planning or cash flow-based planning. So financial planning also has different approaches. Right now, what you're seeing is a goal-based planning approach where you're looking at each goal separately, whether it is higher education for children, for self, it's house purchase, down payment, car purchase, or a new car purchase, or children's marriage. So these are things which keep coming in every financial plan whenever we discuss. And clients generally look at it, how much do I need to save for how long so that I can achieve this amount? And this is true for each and every goal. So what you're doing today, or rather in this slide as you're seeing, is primarily an example of goal-based planning. You're looking at a goal and planning for it, looking at another goal and planning for it. Now, when you're doing it, in this example only, you have to achieve all the 4 goals which are mentioned here. One need to save 18,000 rupees a month today onwards until the time they achieve each and every goal. And that's how it is. Now here, this is an example of goal-based planning. Second part, so here what you're seeing is each goal planned separately, and after that goal is achieved, you stop doing saving for the next goal. The second approach is cash flow-based planning. In cash flow-based planning, you don't look at each goal separately. You look at the whole financial life in one go. How much amount you need to save in totality to achieve all the goals. So in the same example, where you planned for 4 goals and tried to save 18,000 rupees a month from today onwards to achieve each and every goal, instead of that, if you do a cash flow based planning and do a little bit of discussion with your financial planner, your savings requirement, in this case, as you can see on the screen, it comes down to say 8,000 or 9,000 rupees a month. These are, of course, basis the estimation at 12% per annum savings increase in the in your portfolio value, or the return, as you may call it. So the simple approach of cash flow based versus goal based, while the goal based planning is limited only till that goal, and after that you plan for next goal. In cash flow based, you are actually planning for the whole life term by looking at your life in totality, all goals in totality, and going about it. Many times we get this concern from many of the investors whenever we do goal-based planning. After the discussion, it comes out like 18,000 or 20,000 or a lakh of rupees, depending on the investor. That much saving is required. And client says, I can't because my expenses do not allow me. There are fixed expenses and I cannot save 18,000 rupees a month, which is where a cash flow based or looking at the complete budgeting of the client and then arriving at the savings required for the client and how much he can increase. So these are two schools of thoughts in financial planning, depending on the professional who is practicing it, whether goal-based planning or cash flow-based planning, it can be worked out. Goal-based planning has its own benefits because you are, once a goal is achieved, you are free from that savings requirement and then you can freely plan for another one. And it is very focused. You're looking at one particular goal and then going about it. While cash flow planning is looking at your all budgets, expenses, future cash flows, everything in totality. So take your decision while discussing with your financial planner whether you want to go for goal-based or cash flow-based and then go about it. Now, when we look at insurance side of it, there are many questions which keep coming up, whether this much insurance is required. The insurance requirement coming out in your financial plan recommendation is too high. It is very steep. I cannot take it, etc. So before getting into this answer or attempting this answer to this question, let me give you another insight. Whenever we are planning for our financial plan, we should divide our life goals in two parts: lifestyle goals and responsibility goals. One of the most important responsibility goals as per Indian culture is child's education and marriage. While I'm not talking about this from the abroad standpoint or overseas different countries standpoint, but at least in Indian standpoint, responsibility goal of child's education and marriage is very important. Equally important is your own retirement. These are responsibility goals. At the same time, house purchase, at least the first house purchase, is a responsibility goal. While the lifestyle goal are like buying a car. So Purushottam mentioned about investing in depreciating assets or going for vacation every year, every alternate year. These are all lifestyle needs. If they don't happen, nothing changes, nothing goes bad. But if responsibility goals are not met, of course, there is a concern. So when we do insurance planning, we do not look at your lifestyle goals. We look at your responsibility goals. And how we do it, let's just to give you a simple example. Young unmarried, of course, they have certain goals. Married without kids, they have different goals. Married with small kids, they have different purposes or expenses. Similarly, married, grown up and retired. So they all have different kind of needs and expenses. But what kind of insurance cover they require? So my point here, which I'm discussing on these slides, is optimizing your insurance cover requirement. So when you are at what stage of life, you should plan your insurance as per that stage, not because of the attractiveness of the plan or attractiveness of the return. So the financial needs and the age or the age slab or a life stage you are in, the insurance need that you have, unmarried, young, you don't require life insurance today. You require disability insurance. If something happens to unmarried young person, life insurance is not going to cover up everything. It's rather disability is something which is going to spoil his all future things in life. So disability is the part which is required. Once you're married without kids, medical and life, they become very, very important. As you move forward, married with small kids, younger kids, of course, medical and life continue to remain important. As you move up with married, and of course you are married with grown-up kids, medical insurance, life insurance, one thing gets added is a critical illness. Now, as we have seen, even 28 years old person getting heart attack and other sudden diseases which were earlier known for elderly, we need to bring in elderly critical illness, critical illness kind of coverage early in a life. But of course, you should plan according to your pocket and things in this. And once you're retired, of course, there are limited options for insurance. And if you're taking an insurance, it should be taken with a conscious decision and a very wise thought. Don't go blindly because it is attractive and assuring you some return or any other benefit. Your investments for post-retirement are generally for intergenerational transfer, means for your grandchildren, or saving something for your difficult times, maybe medical or any other kind. So the insurance at the later part of the life should be planned in a better way and accordingly. So coming back to the optimizing part of insurance side, insurance coverage is a combination of future expenses for dependents, not for yourself. Because in life insurance, if you're not there, then why you need to bother about anything else? What you need to bother about is your loved ones, whether they'll be able to meet their expenses or not. So that is why you need life insurance. Planned liability. So one is the monthly expenses, which they need to incur and cover up. Second part is the planned liabilities, whether it is a loan or it is future goals, responsibility goals like child's education or marriage. And planned expenses, which are again responsibilities. So these are things which are a sum total, which give you a sum total of coverage required. And out of this total coverage required, you need to reduce the current savings. Whatever you have saved so far, you need to reduce, minus from it. Current insurance cover that you already taken, reduce it again. Current assets, if you have some physical assets or financial assets which can be sold in case of emergency or a requirement, that also should be reduced from this insurance requirement. People tend to forget this. This is the current provident fund corpus that you have because you're serving or if you're on job, so you must be having some corpus. So that provident fund corpus also is going to cover up some part of the insurance requirement. So these are certain things which we look at broadly when we arrive at your insurance requirement. So just to look at your financial life and insurance cover requirement, if you can see the same example which we were discussing while planning goal-based and cash flow-based planning. So there are 4 goals which are mentioned here, and your insurance coverage requirement is continuously, this is life insurance coverage. This life insurance coverage requirement is continuously going up and it is tapering off beyond certain stage in life. Please stop me wherever I need to in terms of time. So this is a standard life insurance coverage requirement. Now, if you do little bit of wise planning and bring in your assets or keep on increasing your financial assets, this coverage requirement, as you can see on the blue line, can come down drastically if you start building your assets equally. So the coverage requirement can be brought down by bringing your financial.
Hello, can I come in?
Yes, yes.
Ananjay?
Yes.
Yeah, it is 5:40.
Oh.
And we should now.
Yeah. Yes.
So I would request you to come on your conclusion as soon as possible.
Sure, Mr. Mehta. Next 2 minutes, I'll be completing that. Right.
Okay.
Thank you. So the insurance coverage part is something which I just mentioned about and touched upon. Coming to the constructing investment portfolio in a quick way, because whenever you look at constructing a portfolio, you must have heard of debt, equity, core, non-core, core, satellite, etc. Let me give you one simple one. This is primarily for investors. You look at your total money, divide your money in grow money, which is where you need principal to be protected, want inflation beating return, and bring in play money. Play money is very important to take it risk, and even if it becomes zero, you don't have any issue. And there are possibility of high returns, of course, but equally return risk is also there. Contingency is something which should be looked at by each and everybody. So the point I'm trying to make, irrespective of what strategy you follow for constructing a portfolio, grow money, play money, and contingency. These are 3 things investors should plan and then reach out to your financial advisor. So the last part, the exercise which I was mentioning, this is for everyone and each and everyone can continue to do your exercise. I'm just taking an example of somebody who is age 40 and having a monthly expense of say 40,000 rupees. Going by the same inflation rate of say 6%, at age 60, the monthly expense of this gentleman or rather family whose 40,000 is the current monthly expense, it would be 1,02,000 rupees roughly. And suppose this person lives till age 80, this person would require a corpus of 2 crore 3 lakh rupees at age 60 so that he or she can live up to 80. So to achieve this, one can start by saving 20,000 rupees from now on, or which is flat, or one can start with 5,000 rupees from now on and keep on increasing at 10% per year and achieve your 2 crore corpus. So I'm sure these slides are there for everyone. You can, I'm leaving them open so that in case if somebody wants to do this exercise while we are winding up, you can continue to do so. So plain and simple, these are quick win exercises for both investors and equally. I'm leaving with all of the audience so that they can practice it accordingly. With this, I conclude my part, and over to you, Mr. Mehta. Thank you so much. Thanks for giving this opportunity to interact. That's it.
Thank you very much, Gautam. It has been a wonderful presentation. And I think the way you have subdivided the presentation, that has probably brought home the finer points. Like goal-based presentation has already been done very well by Sapna. And then you have said that there is a cash flow presentation, and then you have given the pillars of talking to the client, trust. For trust, you need transparency and communication, information, and then, courage to say no. I think these are very important guide areas which you have done in your presentation. And I also like that one is the responsibility goals and other are lifestyle goals. So wonderful. All the three speakers have touched different parts of the such a wide spectrum called financial planning. And I think that has been the most important part of this webinar, that the people who have been hearing it, they carry home with them the complete structure of financial planning. And if any of you have questions, because we don't have enough time for that, so if any of you have questions, you can direct it to ANMI, and we will send it to the person concerned with whom you have. Please write in your questions whom you would like to ask, and we will try that you get the answer on your emails from these people concerned. So I don't know whether you would like to send or share your copy of presentation to those who want it. But if you don't want to do that, then probably reply to your questions is very much in order. And I think I can speak on behalf of all the three speakers and assure my viewers for this kind of liberty to ask questions. Thank you all once again. It is wonderful to have you over. And most important part is your time, which we have taken without any payments. So I'm sure that we deserve it at ANMI, and you owe it to all the viewers who are viewing it from all parts of India. Thank you so much. Thank you very much. Good night and have a wonderful tomorrow. Thank you.
Thank you, Mr. Mehta. Thanks, ANMI. Thanks for the opportunity.